This is InvestTalk. Independent thinking, shared success.
This is Cooper from Oklahoma. Just had a stock idea. Just want to see you guys check it out. It's Paycom. Could you look it over for me and let me know your comments and thoughts? Thanks.
All right, looking at Paycom, and this is actually a name that I'd taken a look at recently, and it's a software company, and it is in the HR business, if I remember correctly, off the top of my head. $11.5 billion market cap, but earnings growth and revenue growth has certainly slowed from a couple of years ago, and that's why the stock has gone from over $500 per share in 2021 now to $200 per share, and its recent low was down around $140 per share. So up off those lows, Luke. But is this a recent uptrend? Portend to, you think, higher prices going forward?
Well, I think they had some positivity coming out of the Q3 earnings announcement, right? They had 11.2% year over year revenue growth and pretty strong guidance headed into Q4. Now, Q4 earnings won't be reported for about another month now. And so the stock's really been ranging for a little bit, down 2% year to date. Taking a look at the balance sheet, though, I mean, they have very little debt, only $81 million in debt on an $11.2 billion market cap company. Cash flow looks to be improving, even with margins staying about where they were, right? 2025 estimated net margin supposed to be 23.7%. That's the best out of the past 5 years, though still down a little bit from 2019 when net margin was 24.5%. And so right now it's trading at forward-looking earnings of 23 times. Price to sales about 6.2 times. That's well below where it has been over the past 5 years. But again, the question is was it just way too high and now it's coming back down to reality? Is it a good investment now? I'm not so sure about that.
Well, it is very profitable, but and they have good cash flow, about $300 million, on $11.3 billion enterprise value. That's about what 2.75 free cash flow yield. That's not amazing, and free cash flow has leveled out with the overall earnings. And you talked about last quarter revenue growth was up 11%, but earnings were down 6%. For the full year expectations for 2024, once they release Q4. Only supposed to be up 1% on the year. It's not exciting growth. So what type of multiple are you expected to pay for that? Even estimates for next year are coming down as well, like you said. So, paying 6 times sales, paying 18.5 times enterprise value to EBIT, it's lower than it has been. But that's, I think, because our growth expectations have come down. And that's what's kind of made me hesitate to really jump on it, is that, yes, it's profitable. Yes, it's starting an uptrend, but the multiples aren't cheap. Okay. And in order for, I think it's still at a market premium, but you look at earnings growth and revenue growth, it's not exciting, especially for this type of, for a software name. So I would pass on it for now. Do you want to start a small position? Maybe, but it just doesn't get me excited to back up the truck at these levels. Because the valuation still is a bit rich for the modest growth that we are seeing. Now, let's pivot over to a live call and talk to Sid in North Carolina looking at Micron.
Hi, Justin. Thank you. Good evening to you and Luke.
Appreciate it.
Yes, I have a small position of Micron, but more or less I picked up at the same price, and probably you discussed a couple of times in the recent past. Do you think this company looks good for the long term? And is this a good entry point or further to add more to my current portfolio? I'm having less than 1% in my portfolio right now. Mm-hmm. So looking for your point of view. Thank you so much again.
No problem. Thanks for the call. Now, the first thing, I'll start with the major pluses and minuses with Micron. The major plus is that they have a good balance sheet. They are generally largely profitable historically. The downside is that profitability waxes and wanes dramatically. If you look at their free cash flow, it goes from positive, huge positives. In 2018, it was at $9 billion in free cash flow. Then it went to negative in 2021, just like it was negative in 2016. And then it moved to nearly $5 billion in free cash flow in 2022, and then negative $6 billion in free cash flow in 2023. So it's up and down. So this is a very volatile name, and you have to be prepared for that volatility. If you think this is going to be your blue chip name that you're going to clip some sort of a dividend, it does pay about pays the dividend about 0.5% dividend yield currently. But that's not what this is. This is a very volatile hardware name, and you need to expect that. But Luke, with that said, what are you seeing on Micron's front?
From a balance sheet perspective, it looks fine, right? It's a $110 billion market cap company, only about $14 billion in debt. You've already mentioned what goes on with their cash flow and what goes on with their profitability. Now, it's down 4.3% today, but it's Drunken Miller said it, and I've said this to you a bunch of times, and I think it perfectly explains what drives equity performance, and that is 50-60% of it is just driven by how the market's doing, macro factors. Another 30% is driven by what the sector is doing. Then the rest, the tiniest percentage, is driven by what the individual company is doing. And so this is a story where, big tech is down, semis are down on the back of talks of more sanctions. And so because of that, Micron is down as well. Like you said, I think getting into a name like Micron, which we do hold, a small position in one of our investment strategies in Micron, getting into it, you have to understand what you are investing in, which you should always understand what you're investing in. But this is going to be a pretty volatile name. That being said, it's trading at 11 times forward-looking earnings. It's trading at about 2.4 times its book value, only about 3.5 times its sales. So it looks pretty cheap where it is to me. But again, you have to understand what you're owning.
Yeah, exactly. And from a technical perspective, it has pulled back at a high of 158 or so, and pulled back recent low was around $85 per share. Now we're at 95. So it is there's some good support here around 85. I wouldn't go hog wild and put a giant position on Micron, but we think it's attractively priced after this large pullback, and it is into support. Thanks for the call. Now, I hope you've been telling your friends and family about our audio podcast being available in video form, and we get questions over on our YouTube channel, and let's tackle one of those questions right now. Dominica's69 says, "Hi, Justin and Luke. It's Matt from England, longtime listener of the show. What's your opinion on SandRidge? I hold it along with Exxon and Diamondback Energy. Great show. Stay safe, everyone." Now, SandRidge is a name that we do own for clients. We owned it for a long time, but we bought it low single digits. Now it's at $12 per share. And it's an energy name primarily focused on natural gas. And with natural gas volatility becomes some profit volatility for SandRidge. But next year, earnings are supposed to accelerate 87% from $1.12 in 2024 up to $2.09 this year on a $12 stock. It's about 6 times forward-looking earnings. And it's trading at a very low, typically trades at a very low price to book. Do you have that in front of you, Luke? Let me see what that is. Yeah, 1. Yeah, so it's trading at basically liquidation value. So it's very cheap at these levels, and I would continue to own SandRidge. Now let's go ahead and dip back into the InvestTalk voice bank. You know the number, it's 888-99-CHART.
I had a question today about Eagle Materials, ticker symbol EXP. I've owned the company for a little bit now, and I'm up a little bit. I just wanted to see how you felt about the company and the sector, and if you think I should trim or hold on to the position. Thank you very much. Bye.
All right, looking at Eagle Materials, and this is a name that has pulled back pretty nicely from around $320 per share in December. Now we're at $240. So certainly a volatile name, down, 25%? In just a little over a month here, down from its 52-week high. Now, what do? They produce and sell construction products and building materials, including cement, concrete, aggregates, wallboard. Think of drywall. So it's a company that's been doing very well as of late with the boom in housing production and remodeling. Earnings continue to go up year after year, but you're starting to see estimates for this year and next year being downgraded by analysts, and I think that's why it's pulling back. But it doesn't look like it's trading at an extreme valuation after this pullback, right, Luke?
No, it's not. It's trading at 14.5 times forward-looking earnings, only trading about 3.5 times sales, which is about where it was over the past 5 years on average. It's got minimal debt, only about $1 billion on a $7.8 billion market cap company. Yep. Fundamentally speaking, balance sheet perspective speaking, I think it looks fine. Cash flow is at least steady. It's not declining too much, below profitability is a little bit. I think my bigger concern is, okay, this is a building products company. What effect may be on the horizon in terms of large scale tariffs?
Mm-hmm. Yeah, that's a certain that could crimp their margins. You know, how much are they importing and selling to home builders and contractors, et cetera. I think that would be interesting to look into. Their cash flow has leveled out here, but at a pretty nice level, about $462 million on an $800 billion market cap. That's about a 5% free cash flow yield. I like that with little debt. Return on equity at 35%, which is good. But historically, the average is in the high teens, which is good. So the question is it over earning right now? Could that come in a bit? And so there's certainly some risk here, but it is at support around this $240 level. And so I like that fact. And generally, I like the fact that we're in a housing shortage. We need more homes. People are remodeling the homes instead of moving. And many people are just stuck in their homes. So they're not putting those on market. And that means just new homes need to be produced. And obviously, our economy and population continues to grow. So I like this from a secular play, and the pullback here. I wouldn't say it's cheap at these levels, but it's now, I would say, fairly priced. Now, this is InvestTalk. Let's play 2 in a row from 888-99 chart.
I am putting money into my Roth on a weekly basis to maximize my Roth because I can't do it all in one drop at the beginning of the year. What's the best way to invest into stocks or ETFs when you can't buy a large block of a stock at a given time? So you're slowly putting into the market on a weekly basis. Do you just pick stocks that you think are going to do well and dollar cost average over the entire year and then adjust the strategy as needed? Or is it best to just kind of blindly invest into these ETFs or index funds? Thanks. I look forward to hearing the answer.
Interesting question. A lot of complexities there. What's your initial reaction, Luke?
Well, I think that what was described, not being able to put all of your money in at once, is in essence dollar cost averaging, which we talk about all the time because one, you don't know where prices are going to move in the short term, right? So you can get inherently lower average acquisition cost, but it's mostly about doing what you can as an investor, right? Not everybody has large lump sums to invest anytime they have an investment idea or a whim. For most people, it's about setting aside money from their paycheck week after week and saving. And so that is something that I think a lot of our listeners can relate to. So in a similar way that you would dollar cost average into stocks, yeah, you can dollar cost average into ETFs. That's my initial thought about the first part of that question. What about you?
Yeah, to me, it's more of what type of strategy are you trying to implement? What's your broader asset allocation that you're trying to hit? And then each subsequent deployment of capital into the markets should be towards that end goal. And whether that is pure ETFs or pure stocks or maybe a mix of both, and there's nothing wrong with any of the three. It's just a matter of what works for you. Obviously, ETFs are a simple way to invest, and it's there's no work there. There's not a lot of work. Let's just say that, because you're generally creating an asset allocation from the top down. You know what sectors you want to exposure to, what asset classes, large, mid, small, growth versus value, international versus domestic, et cetera. And you're creating a broad asset allocation there. On the stock perspective, you still need to do that big picture top down asset allocation plan, but you then can pick kind of the best of breed within particular sectors. You know, that's kind of how we do it on a professional basis. And then you want to, but that takes more work, right? It takes more work to find the individual names that you want to own and then kind of consistently allocate towards it. So I think the answer to your question is, what is your investment and portfolio allocation goal? And then you dollar cost average slowly over time into that allocation. Does that make sense, Luke?
Yeah, that makes perfect sense.
All right, let's pivot over and talk a bit about what I want to get to. Yields are surging, Luke, worldwide. Average 30-year U.S. mortgage is now at 6.9% as of last week. And the higher yields are tightening financial conditions. Certainly one of the reasons why equity prices are down to start the year. And there's certainly some pressure on just assets generally. And when treasury yields rise, investors seek better returns all over the world, right? They can sell their German bonds, for example, and go chase the yield in treasuries now that treasury yields are higher. So U.S. Treasury rates are kind of the base proxy for all types of borrowing costs around the world. And so when yields on treasuries rise, you see real yields around the world rise. So I don't know, Luke, what are your thoughts on the both good and bad of higher rates?
Well, I think there's a lot that goes into it, right? We're having a shift, particularly in the U.S. in terms of fiscal policy, right? Some policies that may be pro-growth, some policies that may be more inflationary than other policies. And so the Fed has taken a step back. And although we expected, or the market rather expected more rate cuts in 2025 than there likely will be, now we're in a position where, okay, maybe we're going to be paused until October. And so on the longer end of the curve, and really throughout the curve, you've seen yields rising. Now, again, that could be driven by potentially higher growth, right? Positive yield movement, rising treasury yields generally coincide with a robust economy, which would support corporate profits and support equity prices. But you're not really seeing that on the equity front. And so I think a lot of it is probably driven by some of the inflationary pressures and primarily being driven by the uncertainty there is in terms of the path of policy.
Yeah, and I'm seeing some news. We have the jobs number on Friday that was better than expected. You've seen some estimates of consumer spending that's actually reaccelerating as of late. So that's the good news. The bad news is that the federal budget deficit is starting to become a big factor, and you have deficits really around the world, not just here in the U.S., that are much higher than we've ever seen in non-recessionary periods. And so certainly the outlook for that debt issuance is driving interest rates and inflation fears, and that's a big part of this as well. And so that's the negative look of this, is that the term premium on treasuries is going up, and that crimps the financial conditions. So that's what we're seeing right now, and why rates are headed higher. Now let's try another question from our InvestTalk YouTube channel. JDude88 says, what REIT sector would you guys look to invest into currently? I'm looking to add some to my IRA. This is a great question. It's something that we internally have worked on over the past month. And at least my favorite subsector, and that's what really he's looking at, is right. The REITs are a sector, but really what subsector? Because there's a lot of different types of REITs that are out there, from retail REITs to industrial REITs to apartment REITs. And that is, I would say, my favorite, Luke, would be the apartment REITs, mainly because we have a housing shortage here in the United States, and we need more housing units. And generally, when you have housing shortage, not only do housing prices go up, but rental prices go up as well. And so generally, I think REITs are going to continue, the apartment REITs are going to continue to do well. What are your thoughts on that? Do you have any other that come to mind to you?
Yeah, I was looking at a couple gambling and leisure property REITs, not the specific REIT gaming and leisure properties, but gambling and leisure property REITs. Mm-hmm. And they have actually been outperforming the broader sector, the REIT sector, of the past month or so. And so those are areas where people tend to, for whatever reason, not necessarily pull back their spending. Americans love gambling. You and I were talking about this the other day. People love gambling. It is everywhere. It is something they do not stop doing. And so those REITs have done particularly well over the past 3 months as there's been a broader drawdown.
That's interesting. Now, the first thing that comes to mind with that argument, though, is it's become a lot easier to gamble just on your phone, right? With Price Picks and all these different gambling, sports gambling apps that are out there. And so will people gamble less in casinos because they actually have to go somewhere versus the gambling from the comfort of their own couch or bed?
Well, we're not just talking about casinos, right? We're talking about horse tracks. We're talking about golf facilities are owned by some of these gambling REITs. Again, the leisure part of that as well.
Gotcha. So lean on the leisure side.
Lean on the leisure.
Who doesn't want to lean on leisure? Love that. Cool. All right. Well, lastly, let's talk a bit about the news that came out today that really pushed oil prices up. And that is the outgoing Biden administration has ramped up sanctions. And I always wonder, why do you think they ramped up sanctions now versus, the Ukraine war has been going on for nearly, is it 3 years or 2 years?
2021, 2022, 2022, I think is when it started. February 2022. Yeah, almost 3 years now.
So, they put sanctions on Russia then, but the worry for the oil market is that this is going to crimp their ability to move oil to India and China, and they're really looking at 183 vessels that ship Russian oil, and that's what they're targeting in order to crimp that supply. And that's moved Brent and WTI at more than 6% since January 8th. So do you think this, why do you think this happened? And do you think it'll really have an impact?
Well, I think that sanctions typically come in waves. I think that headed into an election year for political expediency purposes, doesn't necessarily make sense to potentially raise the price of gasoline for people when they're about to go in and vote in November.
Okay.
But everyone's voted at this point, right?
Yeah.
And so now you're maybe going to do what you should have been doing 6, 7, 8 months ago. One other story, which I talked to you about, is on the back of the Alberta oil and gas minister at a meeting with the president-elect today, saying that they expected 25% tariffs broadly and that crude oil would not be an exception there, right? What does that do to the price of U.S. crude oil versus Canadian crude oil? I know that a lot of the refineries in the U.S. are specifically made to synthesize and refine Canadian crude oil, but either way, right, that's going to raise prices. That might be one of the reasons why West Texas crude is up today as well.
Yeah. And maybe that's underappreciated. A lot of times, this is a lesson for a lot of listeners, is that a lot of times the headlines you see are explanations for market moves that are actually wrong, right? They see a market move and they see a news event and they think those two are connected. And it might be some other factor that really moved that market. And so this may be the case, right? Where maybe the market's focusing more on those sanctions coming out of Canada. So we'll see, but a very interesting story. And usually these things get more overblown as time goes on. Now, I'm Justin Klein with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find, as always, at iTunes, Spotify, Google Play. And be sure to rate and review it on iTunes as well. And remember, if you need help understanding your portfolio dynamics, your risk that you're taking, and how your allocation aligns with the current market environment, I encourage you to head over to investtalk.com, click on the portfolio review button. This is a free and confidential service. And if you haven't optimized the potential of your 401k, we can help you there as well. So start at investtalk.com. Independent thinking, shared success. It's InvestTalk. Good night.